Welcome to the Executive Compensation Podcast. I'm your host, Ryan Harvey, and on this episode, I'm joined by Matt Seto and Adam Hearn. Matt is a principal at Meridian working out of our Toronto office, and Adam's a principal working out of our Lake Forest office. Matt, Adam, welcome to the podcast.
Thanks, Ryan. Good to be here.
Thanks, Ryan. Matt, looking forward to the conversation as always.
Yeah. So, annual incentive plans are intended to motivate and reward executives for achieving annual financial and operational objectives. One of the fundamental principles in annual incentive design is holding the executive team accountable to pre established goals. However, what happens when unforeseen or uncontrollable circumstances arise that impact those annual incentive goals? Should a company always stay locked into the original goals no matter what occurs? Or are there situations where a compensation committee should consider adjustment of goals? Today, we're going to explore this topic further. So, Matt, I want to start maybe with you, and I just want to clarify, what we're talking about when we talk about these various types of adjustments, because as we all know, there's some adjustments which are explicitly called for within a plan document, plan definitions. They almost are automatic in how they operate, and then there's other adjustments that have at least some or maybe a complete discretion from the compensation committee. So, can you kind of walk us through what are those different types of adjustments that we're going to be talking about?
Sure. Happy to, Ryan. And it's an important difference. So many companies we work with today use financial metrics in their annual bonus plan. And many companies that use financial metrics use non-GAAP financial metrics. These are similar to the non-GAAP financial metrics that may be reported in the financials to supplement the reported financials. And really, the theory is the same in that respect. So you're really trying to hone in on what is the ongoing operations of that particular year in terms of the operating results. But they're also used from a non-GAAP perspective and incentive plan purposes to really control for things that are outside of management's ability to control. So some very common definitional adjustments that we often see in non-GAAP financials include things like accounting standards changes, regulatory changes, impairment charges of assets and goodwill, anything related to mergers and acquisitions, so anything restructuring related in terms of the expenses related to restructuring, and then litigation settlements and judgments. These are just a few of the very common list of definitional adjustments we see in non-GAAP financial metrics from company to company. And these will often depend on the specific industry we're operating in. So in this first set of adjustments, you see that these are typically predetermined categories that are hardwired. The most common definition I see is adjusted EBITDA. The adjustments are likely, but not always consistent with what's reported to investors. And so, for example, you may make those definitional adjustments I just listed to every single thing that goes in and out of that reported metric for financial reporting purposes. But from an incentive plan perspective, maybe the tolerance is not 2%, but it's 5%. So there's a different materiality threshold when it comes to incentive purposes. The second set of circumstances where a committee might consider an adjustment is really the unforeseen. And this is really principles rather than rules based. So if you think of the first set that I just described as these are some hardwired rules that the committee and management can agree upon, now we're getting into the territory of principles rather than rules. And so these are really things that don't fit within the category for an adjustment. COVID was a great example, something that nobody foresaw when it happened back in 2020. And many of our clients, comp committees, and management teams really wrestle with the need to make adjustments, both positive and negative, depending on how that industry was impacted by COVID. So really what we're talking about today is more on this second bucket of the unforeseen and setting rules of the road and principles for the committee and management to follow when it comes to adjustments.
Yeah, and as you mentioned, both of those categories require some judgment typically, but it's really that second category which really can be difficult and a struggle to kind of figure out, should we even be talking about making adjustment? At least if it's in that first category, we've already defined that this is something we're going to talk about. There may still be some considerations around what's the appropriate level of adjustment, but it's that second category that can really get tricky. So, why don't we start, Adam? I want to swing over to you and maybe start at a higher level, and obviously we'll dive into some of the details here as we talk further. But Can you just paint a picture? What are some of the basic principles that committees should be thinking about as they prepare to have these types of conversations in the future?
Yeah, it's a great question, Ryan, because as you said at the beginning, one of the fundamental principles in annual incentive design is really holding the executive team accountable to pre-established goals. So for goals that are pre-established and by definition formulaic, the idea of making adjustments to those goals is and should be pretty complicated. There's a lot of factors that should go into that calculus, and there are a number of principles that we think can help provide some guidance. So in order for us to help fully inform committees and hopefully help them generate sound business decisions, we think it makes sense to break down the idea of adjusting goals into three categories, each of which we'll cover this morning. First, we'll talk about when clients should consider making adjustments. So in other words, under what circumstances might it make sense to consider an adjustment versus circumstances when we might advise that clients not, in fact, consider making adjustments. So after we talk about the when, second, we'll talk about how clients should think about making adjustments. In other words, once the idea of making an adjustment has been raised and socialized, what should the process ideally look like from start to finish? So what should the timeline look like? Who should the participants be in those conversations? Should it be limited to the committee and members of management? Should it be the broader board, et cetera? Those types of considerations. And then really, how should that conversation go? What should the cadence of those conversations look like? And after we talk about the when and the how, then we'll talk about the impact of making those adjustments. So once it's been decided that an adjustment is going to occur, what are the consequences of making that adjustment, both externally with proxy advisory firms or shareholders, but internally, both in terms of how management and the board move forward. We'll talk about all three of those.
Well, I think that's a great framework to kind of break this down. So maybe let's start with that first category of when. And as we all know, this can be one of those topics that can be contentious, and sometimes a difficult conversation between management and the compensation committee. So I'd like to hear from both of you, but maybe Matt, if you want to start, what are some of those guidelines that committees should be thinking about to determine when an adjustment is appropriate?
And I'm glad you used the word guideline there, Ryan, because these really are guidelines and principles rather than rules, to my earlier point. So a couple of the things that we consider in terms of guidelines or guardrails. One is that adjustments are only considered for events that occurred after, that were not actually reflected in the budget when you set the annual incentive at the beginning of the period. So this is really in-flight things that happen throughout the course of the year that you didn't anticipate. Maybe a related point is the second, which is adjustments are considered for events which are really outside of the scope of management's ability to control. So we go back to basic incentive design theory. We want management focused on the things that they can control. And for the things that they can't, this is typically something that we'll take a look at, or the committee will take a look at and make a business judgment on whether it gets adjusted in or out. Related to that point is really the third, which is adjustments are considered to really neutralize management from doing the right things for the business, where doing that right thing could have a negative effect on their incentive plan outcomes. So, for example, management should not benefit from a decision to delay a significant investment to save cash flow. So this is just one example where you're really trying to focus management on doing the right thing for the business. And then the final one that I'll talk about, I'll turn it over to Adam, is really adjustments are symmetrical. So it cuts both ways. This is such an important principle, and consistency and symmetry is critical. So if management benefits from an adjustment in one year, well, if that same impact is then positive in the next, you might make a negative downward discretion the following year.
And as Matt started to say, a lot of these principles overlap. So I'll go over a couple more, but you'll see that they're not isolated as separate ideas. There really is some overlap. For example, another sort of guide rail principle is that management should have to live with the consequences of their decision making. So the goal should be to consider making adjustments because of circumstances, like Matt said, that are outside of management's control. The goal should not be to consider making adjustments because of an outcome that didn't go management's way. So as an example, if management chooses to pursue, let's say, a strategic acquisition that ultimately results in a bad outcome, so let's say lower returns than they anticipate, management probably shouldn't just get a free pass on that outcome. An adjustment to annual goals for essentially making a bet that doesn't turn out well can amount to forgiveness for bad decision making. That forgiveness could impact the way that management makes future business decisions and overall can incentivize greater risk taking. That can create a very real misalignment between shareholder interests and realized pay, which we don't want. Another principle is that if adjustments are going to be considered, management should still be expected to manage unexpected events in a way that minimizes the negative impact. What do we mean by that? If management is considering an acquisition that would bring in a certain amount of additional revenue into the organization, an adjustment shouldn't just affect the revenue goals. The adjustment should also probably affect the potential operating expenses impact associated with that acquisition. So it's not just a revenue piece, it's also an expense piece. And the last point that we'll make on this topic is that adjustments should really only be considered when there would be a material impact on payouts. Matt was talking earlier about sort of a materiality threshold that should be part of the consideration. We think there can be a temptation, especially if there's a history of making adjustments and or using discretion. There can be a temptation to make adjustments anytime there are unforeseen circumstances that could impact pay outcomes. And it's important that having in your tool bag the option of using adjustments should really be used sparingly and only if there would be a material impact on payouts. Is it really worth going through a full, robust process around socializing the idea of an adjustment and going through the process of getting it approved and explaining the impact and everything for a relatively nominal change in payouts? We don't think it is. But that probably segues us nicely into talking about the how and what the process should really look like.
Yeah. No, those are great, great guidelines to kind of keep in mind, and many of them I think we're highlighting, as we know, this kind of classic tension that you have between span of control and alignment to performance outcomes, and there's always that little bit of tension where on one hand you want to try to keep things focused on what executives can actually control, because you're at least one level you're trying to drive behaviors, and so having them tied to that span of control makes sense. But very often we have this then disconnect between that and the actual performance outcomes, which shareholders, they don't, at the end of the day, they don't really care about the span of control. They benefit or are harmed by the actual performance outcome. So there's always that bit of judgment, and of course that's why we have boards, is to make that business judgment as to where do you fall on that spectrum and what's the right place to fall. So great guidelines to think about. But why don't we transition into that how question that you teed up. So we talked about, when should we be thinking about this? Now, what is the right governance process that should be followed to make sure that we're kind of doing the right steps to make a potential adjustment?
Yeah, again, it's a good question, and like Matt said, these are really guidelines. It would be great if there was a black and white test for what the ideal process should look like, but of course there's not, and it's going to be different from company to company, and the circumstances are always going to be unique. But we think that there are a few principles that help sort of lay out what an effective process looks like or might not look like. And again, as Matt said in the beginning, it is important to distinguish between sort of the ordinary course events that might have definitions that have been socialized ahead of time and are well understood versus the unforeseen events. And that's really more what we're focusing on here. But the first sort of process principle that we think about is consistency and having a consistent framework for thinking about possibly making adjustments, and ideally having that framework in place ahead of time. So before the year even starts, so that when unforeseen events come up, like COVID was a perfect example, even though COVID wasn't predictable, the idea of having an unforeseen event that would impact results and goals and payouts, that could be foreseen. Even though you don't know what that X factor is going to be, you can predict that there is going to be some kind of X factor. And there are categories where we see adjustments come up, and Matt hit on some of these already. We see this conversation around adjustments come up in the context of M&A activity, macroeconomic factors, changes to long-term business strategy, regulatory changes that have a real tax impact or a tax consequence. But then there are situations where we don't see the topic of adjustments come up, or where we would suggest that the framework or lens that adjustments are evaluated through don't typically concern these topics, like simply changes in the competitive landscape doesn't necessarily suggest that an adjustment is appropriate. If there are regulatory changes that do not have a tax or accounting implication, that might be a situation that doesn't really call for an adjustment. Something like a change in interest rates is probably foreseeable, even though the magnitude or direction of the interest rate change might not be. That wouldn't necessarily go in the bucket of we think an adjustment is warranted. And then there is a whole group of gray area topics where it's really going to be case by case, and there should be a healthy discussion around whether an adjustment is appropriate. And that might be certain kinds of restructuring costs, or foreign currency fluctuations, or unexpected litigation costs, or impact from natural disasters. There's going to be all kinds of topics like that. And more important than having the specific approach defined ahead of time for those categories is having a process in place to talk about those categories and see what management and the committee and ultimately the board think makes sense in those circumstances.
Maybe I'll just pick up, Adam, a couple of additional points and maybe emphasize some of the things that you said. So well-documented principles and frameworks are really important. They're particularly important for committees that don't necessarily like to use discretion very often and would like a rule of the road or a framework to rely on. So it really comes down to comp philosophy. Whereas if you have a board or a committee that uses its business judgment more regularly and is comfortable with the use of discretion, they know an adjustment when they see it, maybe that well-documented framework is less applicable. The second is really multiple bites of the apple. So teasing this up at each meeting well in advance of when the decision actually needs to be made. So if you think of a calendar year-end company where you might ultimately make the decision at the February meeting earlier in Q1, making sure that you're previewing some of these adjustments at the Q3 and Q4 meetings in the previous year. And then making sure that you're articulating really the trade-off stage of the decisions, whether you make the adjustment or you don't. And I think one of the trade-offs that the committee often considers is the disclosure element of this. So where adjustments get into more challenging territory is when the company has to disclose the adjustment, provide the rationale for the adjustment and the proxy in the subsequent year. And one of the best practices I've seen is when a committee is contemplating whether to make an adjustment or not, management actually mocks up that portion of the CDNA to show here's what this section of the CDNA would look like if we did not make any adjustment and it was just as is and you let it ride. And here's the section of the CDNA with the adjustment, with the accompanying rationale and the impact on incentive payout results. This really gives the committee comfort and eyes wide open to go into the decision and to make the decision that's in the best interest of all the stakeholders, but particularly one that's palatable to investors and the proxy advisors.
No, those are
One other point I would
ideas.
just add there is that if we're sort of wrapping up the thoughts about an effective process,
Yep.
communication and transparency are critical. That if we see problems happening in this context, if we see ineffective process, oftentimes it's because of a lack of communication and a lack of transparency between what management is hoping the outcome might be, what the board thinks the outcome should maybe be. The more bites at the apple, like Matt said, the more openness, the more communication between the stakeholders, the better the outcome is going to be and the more agreed upon it's going to be.
Yep. Agreed. And I think one way to build that into the process that not every company does, but I think is effective is making sure that you're talking about where you're tracking on your annual incentive plan and all of your incentive plans throughout the year, not just in the last, month or two of the year, but having those quarterly updates, because very often that will start the conversation. And, and even when oftentimes we think, well, the idea of an adjustment is always going to be generated by management, but it's not always the case. If you're having that regular conversation with the committee, I've seen many cases where it's actually the committee that brings it up. And when they're presented with how things are tracking, they will start to question, should we be looking at maybe making an adjustment based on certain unforeseen factors? So, it's great process to consider. So why don't we hit on the kind of the last piece that you teed up, which is, so what are some of the impacts that we need to be considering both externally, so, investor reactions, proxy advisor reactions, but also internally, there might be some broad employee reactions of the executive team. So maybe you can kind of walk us through a little bit what we should be considering there.
Sure. And I'm happy to kick it off and consider the external part. That Adam will address the internal employee part. So, from an external landscape perspective, as a general matter, the proxy advisors tend to scrutinize adjustments very carefully, as do institutional investors. So, ISS, one of the two main and probably most influential of the two proxy advisors, really notes that if adjustments materially increase incentive payouts, they'd like to see companies provide really clear and compelling rationale as to the nature of the adjustment, the impact, and why the board ultimately considered that adjustment. Um, Based on their recent policy guidance in early 2024, they actually talked a little bit more about disclosure in the proxy of line item reconciliation to GAAP results where possible. So they consider this best practice in their global benchmark policy survey that they do annually. And about 60% of investors that they polled also said that this line by line reconciliation is important to them. So it certainly is both the investor and the proxy advisor perspective that line by line reconciliations from non-GAAP to GAAP are favored in the proxy disclosure. Glass Lewis, I would say, is less prescriptive in terms of what it's looking for and really more principles and policy based. So they're the second of the two proxy advisors. And really what they're looking for is more thorough and transparent disclosure in the proxy, especially for adjustments that material impact incentive plan results. And obviously, the definition of material is going to be different from one company to the next, but they ultimately conclude that they're going to consider adjustments in their recommendations, either for or against, say, on pay. So very clearly important to them as well. And then I guess the third lens is really the investor perspective. And having worked on a number of shareholder engagement campaigns with clients in recent years, specific to executive pay and specific to the say on pay vote, I can tell you that adjustments to incentive plan goals are one of the most important topics front of mind for investors. And they're often a pretty hot button issue that may lead to an adverse vote against say on pay, particularly when there's a very material increase in the payout result, typically above target, and performance is not meeting expectations, either financially or stock price reasons. So once a company has disclosed that adjustment, it's really important to have proactive engagement with investors to really explain the rationale for the adjustment. That may be an important step for the committee to take.
So that's sort of the external piece, but I think that that engagement and getting that buy-in internally is equally important. There's obviously a number of pros and cons to making adjustments or not making adjustments. And I think it's important to remember that the benefits and costs aren't just numbers on a page that get reported and external perspectives get to weigh in on. The decision can have a very real impact on bonus payouts. And as we know, the annual bonus is a big bucket of annual compensation, especially for the executives. So that impact is going to be experienced by the key people within these organizations. From an employee motivation and retention perspective, what can be perceived as rewarding management for making a smart decision for the business can obviously have a positive impact on morale, on culture, and ultimately on retention. But conversely, to the extent that an unwillingness by the board or management to consider making adjustments can be perceived as a punishment for things outside of management's control, that can certainly have a negative impact on the company's ability to retain key talent. So we would caution that there is a risk of setting precedent either way when looking at adjustments and how that could impact future behavior. Whether an adjustment is ultimately made or not made, psychologically, the team can have an expectation going forward that this is how similar issues are going to be resolved. That can certainly lead to disappointment or frustration at some point. So having this sort of neutral framework and consistent approach in place ahead of time can really be valuable.
On the motivation and retention piece that you just spoke about, it's also important to consider the other components of compensation. So what impact has whatever we're adjusting for, whether good or bad, ultimately had on the other components of pay, like long-term incentive, equity incentives, because that ultimately impacts retention as well.
It's a great point. And I think it sort of teased up our maybe our biggest takeaway, which is if the circumstances are right for a possible adjustment, and if there is a healthy process that is open and transparent and well communicated and well socialized, adjustments can be and maybe should be a very effective tool for dealing with unforeseen events. And hopefully the impact, both internally and externally, can be managed as effectively as possible.
Yeah, no, great things to consider, and impacts that I think have to be factored into any of these discussions. So this has been a really helpful conversation, Matt. Adam, thanks for joining the podcast today, and hope to have you back sometime real soon.
Thanks,
Thanks for
Ryan.
having us.